Hey Derek, how's it going today?
Hey, I'm good, Drew. How are you?
I am great. You and I did about 30 seconds of pre-gaming on this, but we decided that it's kind of a time-sensitive topic. We want to talk about some solutions for people out there who may have a Genworth long-term care policy. A lot of them are starting to get substantial rate increases beyond what they may have expected. And so we want to kind of talk about some of the solutions that we've been using for both our own clients and other people who have called us.
Yeah, and not to beat up on Genworth, I mean, all pretty much every long-term care insurance plan that's been sold since the 90s has had some form of rate increases. Genworth was the biggest player. They sold the most long-term care insurance, thus they have the most claims, the most people with policies, thus the most rate increases. But either way, when you go to the mailbox and you open it up and you get that notification that your premiums are going up, it's not fun. So we're just kind of thinking, okay, what can we do to help our clients offset it, kind of using the interest rate? So I want to briefly, Drew, if I can, explain why did all these long-term care insurance companies have to raise rates? It has to do with interest rates. Before the housing crisis in 2008, the 10-year treasury was hovering around, 4, 5, 6%. Pretty normal for the previous 100 years. But once that happened, the Fed kept interest rates low for 15 years. The insurance companies in turn, they didn't predict that we'd have such a low interest rate environment for 15 years. So probably starting in 2013, that's when it really kind of came to a head. Look, we have to raise rates on these policies because we're not getting enough interest from these treasuries. That was the main driver of these rate increases.
Yeah. Having said that, interest rates have gone up over the last 3 or 4 years, but there are still a lot of people who are experiencing substantial rate increases. And like you say, it's not just Genworth. So we're not even talking specifically about Genworth at this point. The main reason why we mention them is they have the largest book of business out there. In order to help the most people out there, we wanted to kind of mention that. Here's how that phone call kind of goes. I've got close to 1,000 clients in that system. When I get a call like that, we immediately kind of do a little bit of fact finding, take stock of where we are right now before we make any decisions. It's very personalized to each person. Let's kind of break that down a little bit without, giving some advice to somebody, to send them off on the wrong track. But what's kind of your thought process?
You'll get calls from people and they say, hey, my rates are going up 30%. My premium's going from, say it's going from $5,000 a year to $7,000 a year. What do I do? And so there's a couple things you can do. The first is you can always decrease your benefits. You can call Jim Worth and say, hey, decrease my benefits 40%. That would offset any rate increases because it is linear. But most people bought this for the benefits, so they want to keep their benefits. Another strategy we've implemented is it's kind of using, okay, interest rates are higher now. How can we use that to offset these premium increases? There's products called equity index annuities. And because interest rates have moved up so high, there's insurance companies that will guarantee a 10% upfront bonus and a 10% simple return each year for the next 20 years. What that means is you can give the insurance company $100,000, 200,000, whatever money you want to give them, and then you can say, "Hey, turn on a lifetime income stream." And they're going to begin to pay you X number of dollars for as long as you live. And in a lot of cases, X number of dollars is way more money that the insurance company will pay you in income than the premium increase. So it's a way to pay that Genworth premium almost and the increase and have extra money to live off of in retirement.
Yeah. So, to kind of break it down, if you think about this high interest rate environment we find ourselves in now, coming off of low interest rates for 15 years, as you mentioned, it was a headwind for long-term care plans, and you can use that same wind as a tailwind to your advantage with one of those instruments. That's one solution. I think a lot of people, and I know the answer to this, a lot of people might be a little confused how we pivoted from long-term care to annuities, but the concept is basically using the macroeconomic environment to your advantage in the types of financial tools that you're using to plan for your retirement. And it changes year to year. I mean, we're not doing the same thing we were doing 5 years ago or 10 years ago or 20 years ago, because the solutions have changed. And so I think a lot of people aren't aware of that.
I think for good reason, annuities, they kind of had a bad reputation for 20 years. And that was really because when you put money into these fixed annuities, you can't lose money. So the insurance company's on the hook to not lose your principal because of market losses. So they really have to have a healthy interest rate market to create compelling products. When that Fed funds rate was 1%, the 10-year treasury was 0.5%. That's not compelling. You can't do too much with that. But now it's gone from 0.5% to 5%. It's night and day. So, I mean, they're creating really compelling these annuity products that guarantee interest um, for as long as 20 years on whatever money you put in, and then a lifetime income stream.
That's one solution. Other examples of things. A lot of clients will ask me, well, my rates are going up, and one of the most compelling options I have is to reduce my inflation protection. And we always suggest if you can possibly do it, keep your inflation protection the same. Because in a lot of cases, if you remove that inflation rider, the net impact is they remove it as if it was never there in the first place. And so it can set you back pretty substantially in terms of what your benefits may be on a monthly basis. Having said that, Derek, a lot of the people that I talked to that we sold these to, say 10 or 15 years ago, they have huge long-term care benefits. And I think some of them can probably pare that back a little bit to also offset that premium. What's your take on it?
Yeah, so a lot of the people who bought it I'd say 2010, pretty much everybody had a 5% compounded growth. And so I've seen some daily benefits with these plans, 350 up to $400 a day. In most areas of the country, that's way more money than you need. So another strategy, to your point, Drew, is just keep your inflation protection because you never know what the future is going to hold. But you can just decrease your, say you have $400 a day, decrease it to 300 a day. That's still going to give you 9,000 a month. And your premium would go down 25% right there. Now, the insurance companies don't tell you that you can do that in that letter that you're getting, but you can do it. You can always decrease your daily or monthly benefit to whatever amount you want. But you can kind of tell they're trying to talk you out of giving up your inflation protection, which unless you have some severe health issues right now, I'd keep it. That's going to be a very valuable benefit that's going to continue to grow your benefits anywhere from 3 to 5% until you reach your mid 80s and 90s. That's when most long-term care claims happen.
And actually, to your point about health, just a quick story time. Had a client probably 3 or 4 years ago contact me, a former professor at one of the Ivy Leagues. I remember him very well. Very nice gentleman. And, he mentioned that he wanted to reduce his benefits. And I said, well, let's talk about your health a little bit. And he was in relatively good shape, but there was a few little kind of early signs of maybe some health problems popping up. And long story short, he went on claim a couple of years later. And so my advice would be if you think you have any potential for upcoming changes to your health, maybe something just hasn't seemed exactly right. You know your health better than anybody. Try to keep everything you've got because even if you've got that $400 a day benefit, you may need a large care expense in the future. On the other hand, which is thankfully applies to most of our clients, if you're still healthy as a horse, you're eating right, you've got a good diet, you're exercising, you might be able to reduce those benefits and then make up for it with one of these alternatives, which is kind of the idea that we've been using with some of our clients. I mean, Derek, tell the story of that client who called you literally a month ago with one of these rate increases and kind of how you helped them out.
I had a client who she bought her policy, it's probably 2007, 2008 range. And it was a Genworth policy. She bought it and her premium was going up X number of percent. Honestly, I don't remember the exact percentage. And she was just wondering what could she do. We were just talking and the conversation came up that she had an existing lifetime annuity that she was receiving money off of, but she bought it in 2019. That was when I said, well, what are the numbers? So she gave me the numbers on it, and it was paying her $42,000 guaranteed for the rest of her life. And I just did some, went to that annuity software we have, just plugged it in and figured out that if we just literally did some paperwork, we're going to take her guaranteed lifetime payment from 42,000 when it was created during the low interest rate environment to $57,500. So on a percentage basis, if I'm doing the math right, that's like a 33% increase in her income just by doing some paperwork. So we had more than enough money to offset that Genworth increase, and she had extra retirement income, about 1,000. I think it was over $1,000 a month. Now has extra, just because we just refinanced her old annuity.
Yeah, I love it. I mean, it's just getting creative, which is half the battle with this stuff is, if we have more information from a client about what their, what their resources are and their current health and all those things, we can help give advice. So, without belaboring the point, we wanted to give a couple specific thinking, kind of thought process, ideas to get your wheels turning. Give us a call if you've got one of these rate increase long-term care policies, whether we sold it to you or not. We can probably help you quickly kind of zero in on what you might want to consider as your options. It's always good to get a couple opinions on these things anyway, because like we said, every single case is a little bit different.
We'll leave the contact information in the notes below. Visit us on our website, ltctree.com, or call us. We'll have our 800 number in the description as well. And we're happy to help, whether you have Genworth, John Hancock, Transamerica, Allianz, any of these companies that have sold these long-term care policies in the past. We're happy to help you make a decision if you got that dreaded rate increase letter in the mail.
That's right. All right, Derek. Well, we'll wrap this one up for today. We are ltctree.com. We'll put some info in the show notes below. Give us a call on our 800 number. One of us likely will answer your call and hopefully help you through dealing with it.
All right. See you guys. Thanks.
All right. See you, Derek.